Okay. And then finally, I think this is relevant. Inventory turnover ratio. So we talked about the banana in the store, um, and not only the gross margin being important, but also the amount of times you could sell that banana. So how do you calculate that turnover? It's the cost of goods sold divided by the average inventory. Okay, so let me just do this for our banana example. Okay, so my inventory value is $1, right? Because I said I can only hold one banana at a time, right? One banana. Now, the revenue, the sales revenue, that's going to be the driver for my gross margin, right? So if I sold this, so sales revenue, $5, right? This is where the sales revenue, that's going to be the kind of important thing for calculating the gross margin. Because let's say I sold 10 bananas, I'll have $50 of revenue, and I'll have $10 of cost of goods sold, right? This translates to the sale of 10 bananas. Everyone agree with that? It's as if I'd sold one banana. It's going to be the same kind of margin calculation, $40, and it's going to be $40 divided by 50, which is the same as 4 divided by 5, right? So the gross margin calculation doesn't matter if I sold one or if I sold 100 or if I sold 1,000. It's going to be the same margin because it really just depends on how much I paid for one versus how much I sold one. Okay. So for the inventory turnover though, instead of looking at revenue, we're going to look at cost of goods sold. So if I sold, uh, if my inventory is $1 and I sold 100 bananas, what's my cost of goods sold going to be? If I took that $1 worth of banana and sold it, after I sold it, I bought another $1 banana, and then I sold it again, and I kept doing that, right? So my ending inventory balance would still be $1 because I only can hold one banana at a time. But if I sold 100 bananas, what would my cost of goods sold be? 100, right? So what this is trying to see is cost of goods sold divided by your inventory is going to give you a sense of how many times have you turned that inventory over to generate sales. Okay, so in this case, it would be 100 over $1. This is my inventory of one banana. This would represent the 100 I sold, 100 sold. So that means that I turned over my inventory 100 times. Okay, so this is the intuition behind what this calculation is trying to get at. So you see how much inventory you hold at any, it's actually the average between the beginning and the end of the year, which is not accurate because like end of the year, you're going to have like way more, right? It's like Christmas and, whatever. There's much more retail that happens at the end of the year. And it's not distributed evenly over the year, like the fluctuations. So it's not quite accurate. But it's like, it's trying to get at some average inventory for the year. Okay, so that's what it's trying to achieve. So you take how much inventory you have and you compare that to your total cost of goods sold, right? Um, and the more times you're able to kind of cycle through your inventory over the year, higher the ratio is going to be. That means you had more inventory turnover. Okay, so um, another way to kind of conceptualize it is to take inventory turnover and so do 360 divided by the inventory turnover, and that's gives you approximately how many days the inventory stays in inventory on average. So if you have higher turnover, is the inventory going to be in inventory longer or shorter? Shorter, right? So that kind of, you can see that with this calculation. So if you had 365, let's say you had a business that had a turnover of 10x, versus 365 over 5, right? This is going to be a smaller number, meaning less days versus this. Okay, so I don't know. I think inventory turnover for me makes more sense. I just like think of how many times you cycle through your inventory over the year. I think conceptually that like makes more sense in my gut than the days in sales. But they're essentially getting to the same idea. Okay, it's just you're just dividing a fixed constant by the inventory turnover. So it's really the same. It's the same number, but just stated in a different way. Okay, so let's look at some real life examples here. These are the inventory turnover for different businesses. RH is Restoration Hardware. What do they sell? Yeah. Furniture. And what kind of is it? Is it like IKEA? It's luxury furniture. Okay, so you can see that the turnover between Costco, which is selling like food and like everyday items, is way higher than Restoration Hardware, because Restoration Hardware is not making like super frequent sales. People probably go in there, look at stuff, chill for a month, just think on it, and then they'll buy it. Like the sales cycle is way longer. Plus, people aren't buying furniture every week, right? People go to Costco every week to shop. So you can see that the inventory turnover is much lower. But what do you think about the margins? Who has a higher margin, Costco or Restoration Hardware? Who has higher margins? I mean, like we saw luxury goods, right? It's very high margin. So it's just two different business models. Restoration Hardware is going to try to sell higher dollar price stuff and make more margin, but they're not going to have as much turnover. Costco has very low margins, but they're just cranking through a bunch of inventory every month. Okay. Now, which one is a better business? There's other metrics to figure that out, but they're just two different business models. So both can be successful. So the other thing, Costco and Walmart, okay? I mentioned that Costco, it's almost once a month, right? This like you can say that their inventory turns over approximately once a month. If it was 12x, then that would be like kind of once a month, right? Every month it's turning over. It's approximately there. Now, I mentioned that they're able to basically order inventory from their vendor, and before they've even paid their vendor, they've sold the inventory. So they never had to really come up with the cash. They're getting the cash from the customer, right? So they buy stuff from their vendor. The vendor says, "Hey, you owe me $100 in 30 days." Costco will sell those items for $200, give 100 to the vendor, and keep 100. So they never had to finance the purchase of that because they're turning over inventory so quickly. Walmart is high turnover, but not as good. But they're still able to do this thing with the account payable, because instead of turning over the inventory faster, they just tell their vendors, give me 60 days instead of 30. Okay. So they're just bullies to their vendors. They're still able to do that thing where they don't have to finance their inventory. They force the vendor to do that, right? The vendor is going to have to still pay their employees, pay their utility bills, and they'll have to borrow the money from a bank or something to do that until Walmart pays them. Okay. And Walmart has avoided having to borrow money from a bank. They're just borrowing from the vendor essentially. Okay. So it's good for Walmart, but not great for the vendor. But since Walmart is such a large customer for a lot of vendors, they just get away with it.